what we're going to sort of cover over the next sort of half an hour, something like that. I'm going to go back and do a bit about the benchmarking report. I appreciate a few of you have been on the webinar a while ago, but given it's budget time again, I just thought it was worthwhile just going through some of the things that had come out of the benchmarking report. Kevin's then going to pick up on the Academies Accounts Direction 22, the Trust Handbook 21, just as a reminder about what you should have been doing to make sure that if there are anything in there that you haven't been doing, that it is done before the end of the year when we come and do the external audit. Academies Trust Handbook 22, we've got a slide in on that, and I'll be perfectly honest, all it's got in it against it is 2 question marks. The reason being, it was supposed to have been released by now. I've chased them again the other day, and I've got an email back this morning saying I cannot give you a timeline for when the Academy Trust Handbook is going to be released.
Pretty sure you say that every year.
I don't know. I mean, they seem to rush around every year doing the Academy's Accounts Direction. Get that out, which is all right in getting that out for the software houses that we have to use to basically get year-end accounts done. But realistically, it's not information that you as trusts need to run your organisations at that point in time. The Trust Handbook is the one that you need, and that's the one that always comes out late. And obviously, it's the one you've got to start implementing for the 1st of September, even though sometimes you're actually not getting the handbook until shortly before, or even sometimes after you've actually broken up as a trust. And the 1st of September might even be a date before you actually get back. So as I say, that slide's fairly quick. There's a couple of question marks. COVID catch-up funding, leases, and the changes there. Did send out an email, but just really a sort of reminder on what's happening on leases, and then 1 or 2 other bits and pieces at the end. So, just a reminder, Creston Academy Benchmarking Report, we issue it every sort of January. There's copies on the tables if you want to take one away. It's really looking at the health of the financial sector. But what it does is have a look at a fairly substantial slice of the academy sector, because we're talking about sort of over 300 trusts and nearly 1,500 schools, which when you compare it to the number of trusts and schools that were actually in existence last August, it's either 12 or 15% of the number. So it gives you a reasonable sort of feeling for what the sector's actually, what's happening within the sector. And just a reminder, I mean, most of you will be familiar to you, sort of the surpluses have been coming through, and this is sort of average in-year surpluses coming through. Primaries, bit of movement up and down there between the last 3 years. Secondaries, just consistently getting bigger and bigger, and then multi-academy trusts getting bigger and bigger as well. So what's that meant as far as average free reserves are concerned? Well, for a primary school, up to 329,000. Nowhere near as big as a secondary or a MAT, but 329,000 if you're a school of 400 or 300 pupils. That's a fair bit per pupil that you've actually got there as free reserves. But as you can see, secondary and multi-academy trusts are fairly significantly moving northwards there. And I do know of some trusts which have sort of £5 or £6 million worth of free reserves, which is obviously a lot to be carrying forward. And just so people are aware, at that sort of level, the ESFA have sort of, by the National Audit Office, been told to have a look at those trusts which are holding sort of excessive, what they consider excessive reserves. So they are sort of paying a bit more attention to them. So reason for those increase of those reserves, again, not rocket science. Late notification of the COVID money, so you sort of really got that sort of late on. Supply staff significantly down, because obviously you didn't need them because the schools were closed for a period of time. Education resources, the kids again weren't in, so you didn't have to spend the money on them. Exam fees, rebates, differed depending on who you were with as to what exactly rebate you got. And then utilities and maintenance, again you were closed, therefore no real sort of catch up on that side. On the other side, other income though was down. So when you're looking at average income per pupil, what you can see is the primary is a bit up on the previous year, really sort of the COVID money's coming through. But in secondaries, slightly down, which is probably to do with that other income from the lettings and things like that. And then multi-academy trusts up at the end. But then we have got a significant number of primary schools in some of those. Average sort of teaching costs per pupil, about 75%. So ASCL tends to talk about 78%. So slightly lower than what ASCL have been talking about. But then the government have been making a bit of comment about the fact that percentage should potentially come down, which seems a bit illogical when you're talking about the health levy and everything else actually increasing the cost of actually employing those individuals. And then, although I was saying sort of maintenance was actually down, what actually happened just in respect to capital was capital dropped in 2020 and then increased in 21, really a result of the late SIF notifications. So because you got late notification on those monies, obviously you couldn't spend them in those years, so a lot was carried forward there. But what is interesting, what you'll be sort of thinking about when actually setting your budgets is actually how much your estate is actually going to be costing to actually upkeep going forward. And we actually, as part of the survey, asked a series of questions of our clients, and only 10% came back and said that the costs of actually looking after the estate would be less than £50,000, 23% between £50,000 and £500,000, and then 2/3 more than £500,000 to actually bring their estate back up to where it should be. So there obviously is a sort of latent sort of build-up of demand for works to be done on the premises. And obviously, as you'll appreciate at the moment, that's getting more expensive. Really because inflation's coming through. I mean, we're talking about sort of 9.1. I don't know what people are actually putting in their budgets. I don't think ASCL have gone quite that far as 9.1. And I appreciate a lot of you will use the ASCL sort of guidelines. But that 9.1 is going to be different in different sectors. Things like maintenance work, plywood, I was speaking to somebody the other day, historically cost about £18, £19 a sheet. It's now costing £44 a sheet. So a significant increase if you're going to do some of that maintenance work, and therefore potentially an additional cost base coming through there. Energy, don't think I really need to say any more than energy. I think most schools at the moment, it's a doubling. The worst I think we've come across so far is somebody who's just come out of contract and therefore possibly was artificially low at £100,000. They're going to be paying about £460,000 a year going forward, so a massive jump for them. So it is something that is going to have an impact and something you'll need to consider when you're doing your budgets. Health and social care levy, I've put it in there just when you're doing a comparison against last year. Just remember we only had that levy for part of the year. When you're looking at next year, that might sound obvious, but I have seen, and I don't think anybody is now still using Excel models, but I have seen in the past national insurance rates change or something and people not actually pull it through on the Excel model and therefore get the costings significantly wrong for the coming year. Increase in teachers' pay, well, probably not for a little while yet, but a couple of years' time that'll probably be coming through and there'll have to be some increases coming through. Increase in employers' pension, actuarial valuations will happen over the next 3 years that the budget forecast return is being done over. So what's going to happen there? Interestingly, there was one actually the other day who was actually talking about the rates coming down, but I have to hasten, he was in a minority of one, and I think that everybody else was saying that they're going to go up. Also, very nicely over the last couple of years, there's been a lot of ICT equipment being given out, but actually schools are getting used to having that ICT equipment. So actually now it's a question of, well, actually in 3 or 4 years or 5 years' time, we're having to think about, well, how do we actually replace that ICT kit? And what sort of budgets are we going to build up to actually replace that? Catch up on maintenance, already mentioned that one. But the other one that's sort of probably you need to have a think about is also if you've actually been awarded SIF projects, what are you going to do with those SIF projects? Because in a lot of cases, you'll have got quotes 6 months ago for that work to be done. You've now been awarded £100,000 because that's what you asked for to do that project. But actually you go out to the marketplace now, or go back to that supplier now, and they go, oh, no, we can't do that project for £100,000 anymore. It's going to be £140,000 or £150,000. Can you scale the project back? Do you actually put more monies in yourself, or do you abandon the project altogether? So those are sort of pressures that are going to come in on reserves we should be having to think about. Now, as I said a few minutes ago, the reserve levels that you've built up have been fairly significant over the last few years. So it might be a question of dipping into those because that's what you're going to have to do to get those projects and that maintenance contract back up to date. Some are going to get caught out with the pupil premium census date. With that changing, that is going to mean that there'll be 1 or 2 pupils that potentially will miss the cut-off. And therefore, obviously, you won't get the additional monies for them. And then spending review talked about sort of 5%, and I put in there, is that enough? And I think the answer to that is probably no. So that's a bit on the little financials. Carbon intensity ratio, Kevin's going to mention briefly this later on, but I thought it might be just helpful because nobody had any idea last year how they compared to anybody else, because it was new for the first year, and it was like, well, is 1 tonne good? Is it bad? What is it? So that's the data from 95 multi-academy trusts across England, and as you can see, the range is everything from 0.03, all the way through to 1.5 tonnes per pupil. I suspect there may well be some mathematical errors in there somewhere, just to have that bigger range, but it might be a reflection of the quality of this state that those organisations are actually working in. And then I know you always like a couple of slides on average salaries, so there's one there on head teachers, and not to disappoint the school business managers in the room, there's one for yourselves as well. So it's all in the benchmarking report, so I'm not sort of saying anything that's not already included in there. And then literally, if you want to remind trustees or directors that we actually do the report, then that's just a link to get you onto the relevant page there, so you can download it or point them in that general direction. So I will now pass across to Kevin.
Looking at the accounts direction, so this was started last year, but for the second year they've split it into 3 separate documents. The actual accounts direction itself and the guidance of that, a model set of accounts, and then the framework and guide for external auditors. I think it probably does just give it a bit of a better flow, so particularly if you're trying to look at the model accounts, it's all there together as opposed to certain notes being on further into the detail and separate. So what's changed in the accounts direction? Start off by saying, you can probably tell by this page, not a lot. So the good thing this year is that we have got consistency in accounting rules, and that is feeding through the accounts direction as well, and that we're not seeing a lot of change. So for some trusts, there is going to be very little change at all. For others, there may be a few additional bits. Well, I'll just briefly touch on each of them. So the first bit is covering the trustees report. So within the trustees report, you have to talk about the organisational structure. It's really just a reminder that where there is a subsidiary or a joint venture, you should also be talking about how they fit into the organisational structure. Governance statement, again, an additional requirement within the governance statement to talk about how the trust manages any conflicts of interest. Again, I'm not expecting people will write War and Peace on this. It's probably a couple of sentences to explain how conflicts are managed if and when you come across them. Next bit is largely looking at a disclosure. So you'll know from prior years that there have been disclosures required for certain severance payments, and the disclosures in the AR have been in a bit more in depth. So what's effectively happening is some of those disclosures are going to land in your accounts. None of the highly sensitive ones, so it's basically just a banding of severance payments. So you have to band any severance payments that have been made into £25,000 categories. So if you've had one severance payment of say 20,000 and one of 40,000, you'll have a little table that says one severance in bracket 0 to 25,000 and one in the bracket of 25 to 50,000 pounds. There's a bit of additional guidance on service concession arrangements and commitments associated with those. So thinking PFI contracts here, and there's actually a useful example within the guidance now. So if anyone is under a PFI contract, anyone in the room? No? Oh, perfect. There's just a bit of extra disclosure that needs to go in there, an explanation as to what those future commitments are. Then next area is, look, if anyone is dealing with a free school coming into the trust or has some significant improvements coming through Priority Schools Building Programme, there's always been a question mark as to what point they hit your asset register, so come into the trust. There's a bit more clarification on there that it's at the point that control passes to the trust. Now, I think generally speaking across the sector, that has been the common sense approach and where trusts and auditors have agreed upon it in the past. I know where we've come across those circumstances, it's the point that we've chosen, but that is now actually in there as firm guidance on that. The next bit is quite honestly just a bit of a pain. So obviously the way that rates were handled was going to be simplified this year, and that the portal was going to be closed. No one would pay rates, no one would have to claim rates back. And then at the last minute, that's been flipped so that some local authorities haven't signed up for that, some have. So we've got a bit of inconsistency. And then to add to the complication, if you haven't paid for your rates from April onwards, what you have to do in your year-end accounts is basically a grossing up exercise. So putting the income in you would have received and the rates that you would have paid as if you're just following on from what would have happened previously. So the net impact is nil. It's purely an accounting entry. And then last bullet point is just removing the requirement to submit dormant accounts. If anyone, so this generally would just be on the start-up period of a trust. If there was a short period before any schools had come in, there'd be a dormant set of accounts and the ESFA wanted them submitting. That is now no longer a requirement, but I suspect will not impact on anyone in the room. And then lastly, at the very bottom, a bit of a change, which again is a disclosure piece for those trusts that it impacts on. So where you've had, or where trusts have had a hub, such as a teaching school, there's been a requirement to provide or include a separate income and expenditure account at the back of the statutory accounts. That requirement has now been removed. Instead, there is a judgment to be made as to whether it's a material income and expenditure stream to split out on the face of the statement of financial activities. So again, with most of those, what I would say is if we ask you for external audit, we won't really be asking for any more information from you. What will actually happen is we'll get the same information and then we will just put it into the statutory accounts in a slightly different way to where we have done previously. And just briefly touching on the framework and guide for external auditors. And this first bit, I've read it about a dozen times, I think, before I could get my head around this, because it's effectively saying that regularity does. So if you've got a trading subsidiary, there's always been the debate as to whether regularity applies to that trading subsidiary or whether it's just the Academy Trust. So now, within the guidance, it is saying that regularity does apply, however, the trust handbook does not. So, in effect, what we believe they are saying there is that regularity is applicable in terms of other laws and regulations. So your subsidiary will need to comply with things like Companies Act legislation, tax legislation, health and safety, etc., etc. However, the Academy-specific regulations, like the Academy Trust Handbook, is not applicable. Because someone's probably going to ask me the question, does that mean you can buy alcohol through the subsidiary? Possibly. is probably where we're at with that. There's certainly a much stronger argument for that, the way the rules are now drafted. But that isn't on the record. The other thing to note is that we are not expecting there to be a supplementary bulletin this year. So you remember the last couple of years there's been an additional COVID bulletin that has come out that's required some additional disclosures. no requirement for that this year. And then moving on, this isn't a change, it's more just a reminder that as trusts grow, there are other requirements that you need to deal with. So there are certain large entity requirements, and this is the criteria on the screen for a large entity, and it's basically 2 out of the 3. So if turnover income is above 36 million, assets above 18 million. Now, important thing to remember on assets there is it's not the net assets at the bottom of the balance sheet, it's gross assets at the top half of the balance sheet. So you're looking at effectively fixed assets, cash at bank, any other debtors being above 18 million, and then employees of over 250. So if you tip the scales on 2 out of 3, you will be considered a large entity in the second year that you tip the scales. So the first year you get a period of grace, second year you need to comply, albeit in the second year you need to put comparatives in. So you might as well gather the information if you're tipping the scales this year. In terms of what it means, requirement to include a Section 172 statement, that largely is already covered by your trustees report. There's a few additional bits and pieces, but nothing hugely significant. For a commercial business where the narrative requirement at the front end is much lighter than it is for an academy trust, moving to a large entity is quite a step change, but not so much because of what you have to comply with already. The main bit that changed is the carbon reporting that Chris mentioned earlier. So it's calculating, in effect, what your carbon footprint is, looking at things like gas, electric, how much you are emitting. There is some guidance for those that are impacted in terms of how to calculate that. But like I say, it's one of those things that if you are approaching through your growth phase, as you're approaching becoming a large entity, it's worth trying to think about how you will gather that information in advance, because trying to go back over a year, 18 months to gas and electric bills can make it quite tricky. So then as Chris said, I'll just give a bit of a recap on the trust handbook from last year, because that is the trust handbook that we'll be considering when we are doing the audits this year. First key change was the fact that it now refers to it being a trust rather than financial, I think. That should read, and that does come into play as we kind of move on. So skipping on the slide a little bit, there's much more emphasis on non-financial matters in there. So things like safeguarding health and safety, estate management. The good news for us as auditors, and for you being audited, is that actually in the auditor guidance this year it was confirmed that the regularity opinion does not stretch to all of this other stuff. So there was a bit of concern around the auditing sector that all this extra stuff was going in. The regularity opinion is based on what is in the trust handbook. As they expanded the scope for that, we were left in a position where we didn't really have the expertise to give an opinion on compliance in some of these areas. But like I say, the good news in the accounts direction is it was confirmed that actually we are still looking at the core financial areas. We're not looking at all this extra stuff. I do appreciate that that's good news from this side of the table rather than your side of the table where it's being expanded and you still have to comply with it all. In terms of some of the other changes, roles and responsibilities, so suitability of members, just making sure that suitable checks are done, making sure that you have reserved enough places on the board for parents, carers, slightly different requirements depending on whether you're a SAT or a MAT as to whether that needs to be on the main board or whether it can be on a local governing body, but those requirements are there. And then a bit of a change looking at the senior executive leader, CEO. So it can only be a trustee if 1, articles permit it, 2, members want to appoint them, and 3, the senior executive leader wants to be on the board. And that is actually something we have started to see a bit of a move away from as trusts become larger, that the CEO is stepping back from formally being on the board and actually is just there as an observer or a contributor to certain aspects of the agenda. There's also a bit in there suggesting that external reviews of governance are more effective than self-evaluation. So looking at getting experts in for your governance reviews and for that kind of critical assessment of how effective governance is at the trust. One of the other things which I think again rolls into some of the things that Chris was talking about earlier, and just this move towards bigger MATs and mergers, is now if an accounting officer announces plans to leave for any reason, that should be notified to the RSE, and they can feed into the plans for replacement in that instance. Maybe I'm being cynical on that, but I imagine that part of that discussion may be around future of the trust and not just replacement of the role. Also elements in there about appointing a governance professional to support the board in terms of the clerking duties and all the other additional bits and pieces. And then lastly, in terms of DBS checks, making sure enhanced DBSs are obtained for staff and supply staff, members, trustee and local and governing body members. Again, DBSs, but as I understand it, there's no requirement to have the barring checks on those DBSs. So then, main financial requirements, needing to review the scheme of delegation annually. So something that would probably have been best practice, but now is formally a must within the handbook. And then publishing details of executive pay on and off payroll where salary and benefits exceed £100,000. So that was a requirement to go on websites for that. Also important to note what that includes as well. So we're not just talking about the gross salary, it's including certain on-costs as well, such as the pension and any taxable benefits. And then bits that hopefully you're all familiar with in terms of things again that have to be published in terms of agendas for trustee meetings, local government body meetings, the minutes of those meetings, and anything that goes alongside those meetings. Obviously there's bits that can be redacted in terms of any individual's names as part of that really need to remain confidential. And then internal scrutiny or internal assurance as we call it, or internal audit, it comes in a various different badges. That's something that the section of the handbook really has grown quite significantly in this area. There are a few tweaks into this year, looking at things. So the first thing is looking specifically at the audit committee itself, if you have a separate audit committee. So depending on the size of the trust, you may be required to have your separate audit committee from your finance committee. For smaller trusts, that can be combined. The key thing being highlighted is that where you have the committee separate, then the chair should not be the same person. So you should have some separation at that point. Again, depending on the size of the trust, that can throw up some difficulties because the person who may be best suited on skill set to chair finance may also be best suited to chair audit as well. And then also in terms of the options for internal scrutiny, just looking at those, there's always been a list of different ways you can undertake your internal scrutiny, whether that be by using an external firm, peer review from another trust. One thing that is now excluded is an internal review by the senior leadership team. And then year-end audits. So a few things just to point out there that most people will probably be aware of. It's certainly been a busy year for this, is that trusts now are required to tender their audit services at least once every 5 years. So there are a number of trusts, I think, who had probably gone beyond that 5-year period, and therefore there's been a lot of tender activity over the last 12 months since this requirement came in. There's no requirement to switch, but you need to be able to demonstrate that you have ensured best value for money. And then there is, as it goes on to that, in terms of assessing best value, there is some guidance in there about the points that must be considered when choosing your external auditor and evaluating the tenders. There's also a completely separate document which is quite a useful document just in terms of selecting an external auditor, which again just gives some hints and tips there as to what to look out for. And then in terms of delegated authority, the severance payment. So if there is a severance payment of £100,000 or more, that now needs to get prior approval. There is another requirement as well, whereby if the individual receiving the severance payment earns over £150,000, again, that needs to get prior approval from the ESFA before you can go ahead with that. And then regulator and intervention. So trusts, there's certain things that you now have to provide if requested. So if the ESFA wants authority for a third party to release information about any of the areas, then you need to make sure that you do you basically give permission to that third party to provide the information. There's also more stuff in the handbook this year about cybercrime and the controls that you should have, the safeguards that you should have, and also stuff in there in terms of ransomware attacks. So again, if you are subject to a ransom attack, you need to get ESFA approval before meeting any demands for that. And then lastly on that slide, again a slight change in wording, but again it's fitting with the changes in the description of the handbook itself, and that what used to be termed the financial notice to improve is now just called a notice to improve. And that takes us on to the 2022 Academy Trust Handbook, which, as Chris has already said, we have no idea when it's going to land. It was definitely going to land before the summer holidays. With every passing communication, that becomes a little more vague as to when it's actually going to land. So I was on a conference last Thursday where someone from the ESFA was along from the team who develops the Trust Handbook, who said it would be mid to late July. Chris has then had an email with someone different in the ESFA this morning, which basically says we have no idea. So, so something's gone badly wrong since last Thursday is all we can deduce from that. And then COVID catch-up funding, obviously that's been being received over recent periods. It's formed to be released, may have already been released this month, just setting out how that funding has been used, and some kind of key criteria that you'll have to complete and return. I think from an audit perspective, obviously one of the things we will be looking at is how you've spent the money, does it meet the conditions, but also the fact that if you haven't spent it all, as things currently stand, there is potential for clawback there. Saving any last minute U-turns that allow the funding to be rolled up into future tutoring funds or something else. But based on the last time I was reading anything, it still had to be spent by the 31st of August. There was no option of rolling forward just yet. And on that note, I'll pass back across to Chris.
UK accounting standards basically follow in the main sort of international accounting standards, except where we sort of make our own rules, as we do. One of the changes around leases, and what happens leases around the world is we've got operating leases over here, which literally are like contract hire, and they just wash through the income and expenditure account, and you have hire purchase or finance lease agreements whereby the asset is capitalised and the liability sits on your balance sheet. The idea of FRS 16 is basically they become the same. So your operating leases effectively become the same as finance leases and contract hire. So you end up having to try and work out what the fair value of the asset is and what the liability is for those assets which you take on a contract hire arrangement. When's that going to impact on the sector? How's it going to impact on the sector? Very good question. It's really going to impact on the sector from the point of view of the SARA, probably rather than your year-end accounts, you'd be pleased to hear. But when it will impact, we don't know. National Audit Office were talking about it impacting for 22-23. Now, usually you would need some comparatives, so that would be the year we're in. So potentially they need some data for that. CITFA, at a conference the other day, we're talking about it potentially not coming in until the year after. Now, as I say, it doesn't apply to your year-end accounts, but what it does apply to is the SARA accounts, which is a combination of all of your accounts put together. So it follows that actually the government are going to need some information from yourselves to be able to actually do this. I've asked about whether it's going to be via the year-end accounts, and they definitely confirmed no, hence why I can say what I've just said. I've asked whether it's going to be via the AAR, whether they're going to want additional information in there, and whether they're going to ask for additional information this year, and they have said not. Where they are talking about it being collected is the Land and Buildings collection tool. So at the moment, they seem to be on the line of the only place where they're going to get data for this new accounting standard is in respect to land and buildings. They seem to be ignoring all your photocopiers, all the minibuses and all that you've actually got. So it'll be interesting to see in due course whether that is something that they start asking questions around. But at the moment, it just looks like land and buildings is where they're heading. The other thing that's interesting about sort of the leases is the change which is coming into effect from September. And historically, we've had a lot of phone calls about, well, is it an operating lease? Is it finance lease? What is it? Because we know that we can't enter into those finance leases or hire purchase agreements. Well, from September, in effect, they're treating them all as one. So provided the actual agreement fits into one of the categories which is listed on there, so is the lease already in place by the 1st of April for an LA school, or the 1st of September for an academy, or does it fit into any of these headings here, then basically it is allowed whether it's an operating or a finance lease agreement. The problem at the moment is trying to find out what is in these headings here, because what they ask you to do is send an email to them and they'll respond. The automatic email comes through and all it does is give you that list. So it's not the most helpful. What I have found is that photocopiers and franking machines are both being classified as IT equipment, because I've put in specific questions via another gateway to try and find out what is covered where. Would I have sort of bet a substantial sum that both of those would be included in ICT costs? With the way the SFA work, no. So they are supposed to be giving us more guidance in due course as to a breakdown of all those, but that I was promised about 3 months ago and still hasn't appeared. So it is sort of, it's well, it'll happen sometime, but when, don't know. And the fact that potentially the impact of the standard might be put back a year might mean they do a U-turn on this. At the moment, nothing's come out to say this is changing at all, and given now we're fairly close to the 1st of September, I think they'd have to sort of stand by this, but again, you can never trust the ESFA to not change things at the last minute. The other one that we've been asked a lot of questions around is energy efficient lighting, whether things are operating or finance agreements. Now obviously, as I've said, post 1st of September, that might not make a difference. At the moment, they're not on the list of items which are sort of being sort of given the nod on straight through. And obviously there are a lot of people looking at energy efficient lighting from what I said earlier, and the fact of your electric and gas costs are going up significantly. So what's come back to me at the moment is, use the Salix. Well, I'm saying, well, yes, that's all right, well and good saying that, but it's basically oversubscribed several times over. There is apparently a Salix type scheme under consideration, which may well be released later on in the autumn. And then what they're saying is, if you get one of these contracts, get all the information you can together, and then just submit it to their sort of help to buy for school services, and they will help you through the process, is what they're saying at the moment. But it's one of those things, I mean, you need to sort of work, obviously, see what the cost of it's going to be, try and work out what your payback period is going to be, and sort of try and gather as much information as you can before putting it into that process. But at the moment, they're not offering a definite sort of tick. It's going to be allowed from the 1st of September onwards. It's just something that they're considering at the moment. And then gag pooling, what I'm going to try and get going forward is, I've got somebody I know on the south coast who's done gag pooling, and what I'd like to do is try and get them to do a bit to camera about what the sort of how it worked for them, what were the sort of the advantages, what were the disadvantages, what were the hurdles along the way, because I'm fairly sure there'll be certain things along the road which will trip everybody up, and the sooner you know what might trip you up, the sooner you can plan for it and avoid it. But I asked about gag pooling from the point of, I'm well aware that different things seem to be happening in different parts of the country, in that I've come across a situation elsewhere whereby the school was actually, the trust was actually gag pooling, and then one of the schools left to go and join another trust, and the trust which was leaving thought, yep, that's all right, off you go. You can take away your sort of pupil premium money and your bit of sort of PE site money, and that's it. No, they came back to him and actually said, you've got to unwind the last few years that you've been doing gag, try and work out what the actual school balance would have been, and then that's got to be what's being transferred. And I've said that's a bit of a nonsense if you're wanting schools to pool on the gag side, because if we're talking sort of 5, 6, 7 years hence, trying to work that back over would be an absolute nightmare. So what they came back with was literally saying, well, in the accounts direction it says, just set out what the school balances are, and if they're nil, put in nil. So what I think our advice is at the moment is, if you do go down the gag pooling line, is at the back of the accounts where it's got the school balances, you actually sort of specify in there what is actually included in there. So if it's just the pupil premium and sort of other ancillary grants that are being carried forward, you say that. So the rest is being gag pooled, and just leave it at that. And hopefully that'll mean that the department can't come back to you and ask you to unwind, because you've made it very explicit in your accounts what balance that school is actually carrying forward. Now that's not to say that you might not get into a situation whereby you have commercial discussions between you and another trust, because that's another thing I have seen, is a school wanted to transfer a school from it to another trust, and in the end they actually paid the trust that was acquiring an additional £50,000 to take that school off them, because they knew how much of a problem it was for them, but they thought this other trust could sort it out. So there have been commercial discussions as well on that side about sort of making payments across. And that was all I was going to say on gag pooling. That is obviously Kevin and me and our contact details. We have finished around sort of 4 o'clock, which is when we said we were going to finish. Thank you very much for sort of coming along today.